Hi, everybody. Welcome back from the break. Our next session is financial disclosure and accounting fraud. We've got a great panel. So let me introduce our panelists. We have Michael Garibaldi, who is the managing director at FTI Consulting, and he's currently serving a 2-year term as an officer in the Forensic Services Fraud and Financial Investigations section of the California Society of CPAs. Previously, Michael was an auditor at PricewaterhouseCoopers. Ruth Hawley. Ruth is an assistant regional director in the SEC San Francisco office. Jennifer Lee is a partner at Jenner & Block, and Jen is a former assistant director in the SEC Division of Enforcement, and she had that position for 12 years. Our moderator is Craig Martin. Craig is a partner at Morrison and Foerster in the San Francisco office and serves as firm-wide managing partner. Formerly, Craig was an enforcement attorney in the SEC San Francisco office from 1999 to 2002. And Fuad Rana is currently counsel at Davis Polk in their Washington, D.C. office, and he previously served as an assistant director in the SEC's Division of Enforcement. Thanks so much.
Great. Thank you very much. Our panel is financial disclosure and accounting fraud. And so I'm not going to promise you too much, but I am going to promise you that you 45 panawatt free minutes. Okay, just enjoy it. Wow. I'll also just point to a practice tip because I know many people in the room are defense lawyers like me. You never know where you're going to, how ultimately your relationships are going to be with the staff, and on any given matter. And I'll just say that the 3 people to my left have either because they're currently on the staff or in their prior positions at the SEC or across the table from me on various investigations. So, Mike, you are the only person who has not hurt me. And I was wondering where you were going with this. Mike and I knew you were going to say we've tortured you. No, I'm just saying. All I'm saying, Mike is my favorite.
But who tortured you the most, really?
For the answers to that, somebody's going to have to buy me a cocktail after.
He's pretty cheap, is what he's saying.
True. So I thought we're financial disclosure and accounting panel. I'm going to start with some numbers naturally. So, a recent report on the enforcement results of fiscal 2023, the number of new accounting and auditing enforcement actions increased 22% in fiscal 23. That is compared to only an 8% increase in enforcement matters generally during last fiscal year. There were 83 accounting and auditing enforcement actions. That was the highest number of actions, annual actions initiated since fiscal year 2019. 35 of those actions involved individual respondents only, while another 14 involved both individuals and firms. Of the individuals who were named as respondents, 24% held the title of CEO. That doesn't surprise me. 22% held the title of CFO, and that doesn't surprise me. 24% held the title of auditor, which did surprise me. And Mike is going to shed some more light on that for us soon. About a third of the individuals that were sued by the SEC in these actions were CPAs. One stat I don't have is the number of accounting cases that were brought last year where the respondents were alleged to have just pulled out all the stops at the end of the year to make that number. I've not seen that statistic reported. I do have a wholly unrelated statistic, however, that over half of the SEC's accounting and audit enforcement actions were brought in the fourth quarter of the fiscal year last year. Just a coincidence. So the cases that were brought last year, it was a real mix of bread and butter accounting cases as well as maybe some old theories that were given a new life. And so we're going to talk about four basic types of cases today: earnings management, auditor enforcement actions, accounting controls, and perks reporting violations. But first, we're going to turn to Ruth about the year in San Francisco, bringing these types of cases as well as the program more generally. So Ruth, when I think the San Francisco regional office has a reputation for bringing large, complex accounting cases. Some may argue that the office is living in a target-rich environment, but I'm wondering if you could talk a little bit about the types of matters that were brought within the last year and the main takeaways from some of those cases.
Right. So, as you said, the division has been doing a lot of work. But first of all, to start the panel off, I want to focus on my favorite regional office, the San Francisco regional office, as you said, which we do, as you said, we do. That's great. We have that reputation. I would say it's not exactly the bread and butter. Since it's San Francisco, it's more like toast and avocado of our program. But in all seriousness, obviously this is a staple for us. It's an important area. Investors need to get the right information in order to make their investing decisions. They need to be fully informed. And it's going to continue to be an important area. No surprise to anyone. But so to highlight a few of the San Francisco regional office's cases, the first one I want to talk about is Greenbrier, and that's an executive perks case. So perks cases, what I mean by that is where an executive is getting, either an executive or perhaps a family member of an executive is getting some kind of compensation or benefit from the company that is not being disclosed to investors. And in the Greenbrier case, the CEO owned a private plane, and he used a company to rent out that private plane for chartered flights. And his own company rented that plane or chartered that plane to fly him and the other executives around. So he was indirectly receiving about $1.6 million in compensation that was undisclosed to investors. That was one of the issues in the case, one of the main issues in the case. And I think this is an important case because, and the other perks cases as well, which we may get into later, this is important for investors to understand so they can really evaluate the relationship between the board of directors of the company and the executives, and understand also, the shareholders of the company need to understand the full compensation package of the executives. And I'm not going to talk about Panawat, but I do want to talk about cooperation. And so Garibaldi kind of scooped me a little bit on this. No, just kidding. I wanted to highlight two of the recent cooperation, meaningful cooperation we've had in two San Francisco regional office cases. And one was Klupin. It was brought earlier this year. And in Klupin is a Chinese, or it's Klupin Group Holding Limited. It's a Chinese company whose shares are traded on an American stock exchange, or were formerly traded on the New York Stock Exchange. And so it was accessing the United States capital market. And the accounting fraud there was that there were senior managers at the company whose compensation and bonuses were going to be reduced if they didn't meet certain targets, certain quarterly targets. So that was really an incentive that led to a fraud where they ended up prematurely recognizing revenue by recognizing revenue where work hadn't been completed, and in some cases when the contracts with the customers hadn't even been signed. So that's the bad news. The good news is that within a few days after they started an internal investigation, Klupin did self-report to the SEC. And they also provided meaningful cooperation during the staff's investigation. For example, summarizing witness interviews that were in Chinese and translating those interviews, and also identifying and translating key documents. They also instituted remedial measures. They fired or disciplined the people that were engaged in the fraud, reorganized the departments, they strengthened accounting controls, and they hired people who are more familiar with US GAAP requirements. And so the SEC did not impose civil penalties against Klupin in light of its cooperation and self-reporting. Second case is View. This one was settled charges against the company, which is a manufacturer of smart windows. And apparently this means that the windows actually change tint when the light hits them. From, if it's sunny out, you get a more tinted window, and if it's dark, you get a light window. But more importantly for us, View had disclosed warranty liabilities of about $25 million, but they really should have disclosed about double of that. The warranty liabilities were their projected costs to manufacture replacements for defective windows, but they had not included in that other costs related, like shipping costs and installation costs. And under US GAAP, those should have been disclosed. So again, View self-reported the conduct and provided really meaningful assistance to staff. They gave us detailed financial analyses and explanations and summaries of factual issues. And they actually proactively identified key documents and witnesses to the staff. I want to note the SEC has also filed litigated charges against View's former CFO, and that litigation is ongoing. But again, the View company did not pay a civil penalty based on its cooperation. The last case I want to mention from the San Francisco regional office to start off with is the Granite construction matter. So this was a case that we settled with the company, Granite Construction, but there is litigation against the CEO. And so the complaint, this is allegations in our complaint that I'm going to refer to. The CEO, we allege the CEO improperly deferred costs to hide sort of a flagging performance and manipulated a percentage of completion measure with a revenue recognition measure. And Granite settled with a $12 million penalty. One thing that's notable about this action is there were several executives of the company who are not charged with misconduct, but they did, under SOX 304, there was a clawback of their certain compensation and bonuses that they had received. And so that's notable because, I think that it's important for your clients to be on the lookout for that as well when they're thinking about risks within their companies.
Great. Yeah. Thanks, Ruth. Just one quick question. So for many of us who are representing individuals in front of the staff, particularly in a complex accounting case, where so many of the decisions and the actions are collective, are there things that resonate with you or with the staff more as when a lawyer is arguing on behalf of an individual, not putting aside the cases that you've discussed, but more broadly, I was relying on accountants. I was a low-level employee following orders. A dog ate my homework. The sun was in my eyes. I mean, is there? Do you have any tips for lawyers who are trying to help an individual get ahead?
Well, we try to get our charging decisions right, and we try to be fair. I do think that some of the things that you mentioned could be taken into consideration. I'm a cat person, but so as far as lower level people, we tend to look for the people who are the most responsible, with the view that the folks at the top, should be the ones who, if they're culpable, should be the ones who are going to be looked at the most closely. But there is a problem too when you mentioned, I think, reliance on accountants and auditors. Sometimes when we hear that, it's not really an argument that it can fully be credited, because when we dig into it, there isn't full disclosure to those accountants and to those auditors, such that the accountants and auditors actually have all of the facts necessary to really give that clean audit. So it can't just be that you've passed your audit, right? That's not enough to give you a defense. It has to be that the auditors really knew what was going on. And then as far as having an organization where everybody has a little piece of the pie, that can happen sometimes where each of the individuals, like the evidence might not show that each one of the individuals had a piece of the pie or had a little piece of the puzzle, we'll say, but there was no one person who knew everything necessary to bring the charge.
Can I jump in?
Please.
Of course. So I think one of the issues is, in these cases, a lot of them deal with judgment-based areas. And so in a fraud case, right, all the accountants in the room, probably not going to be looking at just, for this particular area, what did management exactly think to a certain degree. There's got to be management deference to some of the assumptions. And so I think one of the issues for us on this side now is, when you're looking back, if there's not a sufficient audit trail to say, here's how I came up with that number, if the only other explanation is, well, there seems to be a tie to incentive-based compensation. There seems to be a tie to, hey, you're now backing into a target. You've now hit your EPS, multiple quarters in a row. It seems like the SEC is going to say, well, obviously that's earnings management, that's fraud, that's something else. So I do think that's one of the issues of just, if you don't have proper documentation, you're probably going to get in trouble. I don't know if you have a view on that.
Yeah. That sounds like evidence for scienter to me. So,
Jen, you mentioned earnings management, and I know the SEC has been bringing more cases in this area. Why is that, and what types of cases?
Because earnings management, the term alone, it just sounds like, that sounds so fraudulent, right? And I think it's fair to say, like, for the people in this room, your ears start to perk up, because it seems like a big issue, but it may or may not be fraud. And I think in this particular economy, this issue, for me at least, is top of mind, because the economy's tough. Interest rates are rising, and there's been inflation, and things just cost more. And companies are under pressure to basically hit their targets and make sure they're keeping investors happy. I was, in preparing for this, I was looking, it's like the Wall Street Journal was like thinking about our panel prep, and they came out with an article saying companies really are under earnings pressure. So for Q1, companies in the S&P 500 are on pace to deliver a 5.4% jump in profits. But then the ones who fall short are likely going to be hit with at least a 3% stock price decline. That is a big deal, right, for most of the people in this room. So I think unsurprisingly, we're seeing a bunch of companies resorting to aggressive accounting to make sure they hit their EPS targets, they smooth earnings, or they back into other predetermined targets to keep investors happy. So there's a couple of cases that I just want to highlight that go through some of these issues. So in, I'm never going to say this right, Gentex, the Home Office brought a case where the chief accounting officer, at least according to the SEC, directed the reduction of an accrual of a performance-based bonus program, and the result was meeting consensus EPS. The next month, the Home Office, again, your office, DXC, essentially the SEC found that the company misclassified expenses as one-time transaction costs, and the result was the company materially increased its non-GAAP net income. And then in September of last year, again, Home Office, I don't know if this was you, Fuad, the Home Office brought another case against Newell Brands, with the finding being that the CEO pulled sales forward, and the result was the company was able to report core sales growth in line with targets. Recently, there's been another case, or at least some kind of investigation involving Chemours, which announced that its CEO, CFO, and principal accounting officer, this again, according to the company, delayed payments to suppliers and accelerated the collection of payments, but again, according to the company, the result being that they were able to meet cash targets related to incentive-based compensation. So these are issues that I think are top of mind for us. And by the way, I should say, none of these companies were Silicon Valley-based companies. None of this involved the San Francisco office. So we're either doing a good job keeping our clients out of trouble, or we're not doing a good job finding these cases, but nonetheless, they're out there. But the SEC is looking for these cases, and they're still doing data analytics. They're willing to bring company-only settlements, but likely, let's be realistic, hoping for cases that involve individuals. And from my perspective, the conduct is pretty wide-ranging in terms of what the SEC is looking for. So it could be what I mentioned before, the lack of an audit trail and just no other reason out there except for something that seems nefarious, or it really is executives trying to manipulate targets to, hit their bottom line.
So Jen, like you mentioned Gentex and the decision made to change an accrual so that a target wasn't missed. I mean, is that what these cases are about, where the SEC is saying, like, you basically, once you've made that accrual, you've lost the right to change your mind? Is that?
I think it's where if you don't have the rationale and if it doesn't seem reasonable, and then the only other reason that is there is, coincidentally, there is some change to your incentive-based compensation, then the SEC is more likely going to infer you didn't have a rational reason for doing what you did. Because in my experience, when I was still there, if there was some kind of rational reason, then it'd be much harder for the SEC to second guess that. They don't want to dig into business judgments.
Mm-hmm. And I don't know, Fuad, anything that you tell clients in terms of helping to protect themselves from being second guessed down the road?
Sure. So I won't talk about Gentex because I worked on that case when I was at the commission. But the line of cases that Jen was mentioning, DXC and Newell, these are sort of non-GAAP cases where companies were sort of managing to a target. I think it's clear that the SEC's view is that if your goal is to try to meet a target, it could be a Wall Street target, it could be an internal target that the company provides guidance on. It could be a purely internal target that the company did not disclose publicly. But I think the SEC's view is that if you're managing to a target, you are taking on a potential disclosure obligation, and that obligation is heightened where you're sort of taking atypical practices to meet that target, and that practice might impair your ability to meet a target in a future quarter. That's sort of the recurring theme in some of these non-GAAP earnings management cases that Jen was talking about. I think it's an interesting question that's raised, is whether a company could disclose away the enforcement risk around these practices. You mentioned the Newell case, which was a pull forward case. I know Craig knows about pull forwards and pull-ins very well. We had a case together on that a few years ago. But imagine a situation where Newell had disclosed publicly, we engage in sales practices periodically when we have, variation in customer demand, and sometimes we may resort to those practices and they might impact our future ability to meet our financial targets. Would the SEC have a case if a company made that disclosure? I'm not sure that they might under the sort of current approach to these disclosure-based violations.
Although, can I say, I mean, I do wonder, I know the SEC has taken the position that if you say you may do something, but if you don't disclose you actually are doing that, then they will bring cases in that circumstance. So I do wonder if they might bring a case there.
Yeah, I think you could just sort of say that we do this as a matter of practice. And I think if you make that disclosure, we haven't seen that fact pattern yet. We may never will see that fact pattern. But I think it does raise the question that a lot of these sort of non-GAAP earnings management cases are disclosure-based cases where there was sort of no disclosure at all that put investors on notice as to how the company was meeting its targets. So beyond that, if you take that sort of that theme to its next step, there's sort of basic steps that companies can consider taking to mitigate the risk. You mentioned good documentation around discretionary judgments. That goes a long way. And also identifying and inventorying what metrics you're talking about. A lot of these cases, the SEC is focused on what metrics the company is specifically highlighting. It makes it easy for the SEC to establish materiality, makes it easier, Ruth, to your point, to establish sort of potential intent. This is what's important to management. And so getting a handle on what management is focused on internally and externally, and sort of thinking about proactive disclosure on those issues is a good way to mitigate the risk of this area.
Thank you. Well, Mike, I wanted to turn to you. I expressed my surprise at the level of enforcement, at the number of enforcement actions involving auditors last year. At the same time, we do see the chief accountant making increasingly aggressive statements about audit quality and professional skepticism. What is going on in the world of audit?
Yeah, thanks, Craig. So as the accountant on the panel, I'll go ahead and lean into the accountant stereotype and give you a few more numbers and statistics. So in 2023, the SEC brought 17 enforcement actions against auditors, and that number was up from 2022 when there were 13 actions, 12 actions in 2021, and 11 actions in 2020. So there is an increase, especially last year, but looking at this compared to a decade ago, when the SEC announced what it referred to as Operation Broken Gate as part of its renewed efforts to...
That's subtle.
Yeah, Operation Broken Gate, as in the gatekeeper. In 2015, for example, there were 44 enforcement actions against auditors. So while we have seen this uptick in cases, and as I'll get into some of the chief accountant's statements on this, the number of enforcement actions by volume is still a little bit lower than what we saw 10 years ago. So with regard to Chief Accountant Paul Munzer's statements, he's made a few recently regarding the role of accountants and auditors and their role in the capital market that I wanted to highlight. In February of this year, he issued an investor protection call where he focused on professional skepticism and audit quality. And in that statement, he referenced the recent PCAOB inspection reports, which the 2023 report, which covered the 2022 inspection period, it found that in over 40% of the inspected audits, there was insufficient audit evidence to support the audit opinion. That number was up from 2022, where it was 34%, and in 2021, it was 29%. So a pretty alarming deficiency rate. Again, he focused on the need for auditors to exercise professional skepticism. I go back to my early years as an auditor, and my first audit partner referred to it as trust but verify and be sure to verify. And auditors have a responsibility to question management, and they have a responsibility to obtain persuasive evidence to support management's assertions. And then one other statement from Chief Munter was just last week. He issued a statement on fostering a healthy tone at the top at audit firms. And I thought that was interesting because accountants and auditors use the phrase tone at the top quite often, but usually it relates to clients, public companies, public issuers, and the tone at the top and the culture, the internal controls, the control environment there. But in this case, Chief Munter was talking about it from the perspective of the audit firms and the audit firms needing to self-reflect on their tone at the top. And he referenced instances where audit firms were subjects of enforcement action, yet there were still high-profile partners in leadership positions and seemingly no professional ramifications. Moving on to just a couple of cases to cover enforcement actions against auditors. The first is Markham. So Markham LLP is a top 15 audit firm, and in June of 2023, they were charged with quality control failures and violations of the audit standards. And over a 3-year, leading up to this, over a 3-year period, Markham more than tripled the number of its public issuer clients, the majority of which were SPACs. And so that would seem to be the focus of the SEC's investigation. And they found that 25 to 50% of Markham's audits were deficient. So as part of that, Markham agreed to a $10 million settlement. And relatedly, and this goes back to the tone at the top issue, just a few months later, in September of 23, the SEC charged Markham's national assurance practice leader for his failure to sufficiently address and remediate the deficiencies that were found. And they imposed a $75,000 civil penalty and a 3-year ban from him serving in firm leadership and managerial positions. The other case I wanted to bring up was earlier this month. I thought it was quite interesting. The SEC charged the audit firm BF Borgers and its owner with deliberate and systemic failures to comply with PCAOB standards. And BF Borgers somehow built the 8th largest list of client list of U.S. audit firms, and they had over 370 clients and reviewed or audited over 1,500 SEC filings, and this is all coming out of one single store, reportedly one single-story office building in Denver, where there are about 50 employees, only 10 of which were CPAs. And Mr. Borgers himself had signed off on over 140 audit opinions in the past year alone. And so there was a number of egregious findings here. The SEC found that 75% of the firm's work was deficient. Some of the findings included the auditors using work papers from previous engagements or other clients, taking work papers from the prior year audit file and just changing the date and including them in the current year file, and documenting work that never was performed. So Director Graywall referred to this as a sham audit mill, and he called it, quote, one of the largest wholesale failures by gatekeepers in our financial markets. So BF Borgers agreed to a $12 million penalty, and Mr. Borgers $2 million, and both respondents have agreed to a permanent suspension from practicing in front of the SEC. So I think between
and there was a fraud theory underlying that case too, right? And it wasn't just simply that they were not complying with PCAOB; they actually sued them for fraud.
Yeah, correct. And I think that it just anyone who's worked in the audit and accounting profession know it's impossible to get through that much work with so little employees and so little resources. So I think between Chief Accountant Munter's statements and some of these enforcement actions, we see that the role of the gatekeeper continues to be a focus of the SEC and one of those, quote unquote, evergreen areas that's talked about.
I mean, I think the two cases that you mentioned are very clear, and I think you used the word egregious by examples, right? And so I do think the SEC is trying to be careful in terms of how they're looking at accountants, how they're looking at lawyers. So it isn't like everybody should be ducking and covering and worrying that the SEC is now going to be out and suing them for professional malpractice issues. But I don't know if that's your take.
No, I agree with you. I mean, I think that there's a lot of gray area in the professional standards and in the literature. It's not always black and white. So, particularly the BF Borgers case, which I just thought was interesting, and hopefully some of the former auditors in the room did as well. Some of those violations were pretty shocking. So.
I just want to add, going off of what you said, Mike, you're describing the auditor cases that we brought over the last year. Some of them are, like you said, are quality control, let's say. failure to meet audit standards. But there's also another category of auditor cases, which is auditor independence, which is also very important. We're mindful of the time here, but anybody who's interested, we brought a Prager Metis action where the auditor was actually indemnifying its clients through its engagement letters.
Great, thank you. So Fuad, I'd like to switch gears a little bit and talk about accounting controls. Accounting controls were this homely tag-along addition.
You're really selling this topic.
Yeah, making it so exciting.
Well, but now they're having their moment in the sun,
Yeah.
and it seems like the SEC is bringing a more expansive and exciting theory to controls. What's going on?
Yeah, so you're exactly right. Internal accounting controls, maybe not the sexiest topic until now. Tag along in many financial fraud cases, not an area where you would expect to see heated dissents among commissioners, but in today's environment, things have changed. SEC has sort of taken a very different view of the accounting controls provision, and there have been sort of two notable developments in the last 6 months, which show that the SEC is sort of doubling down on its approach that the accounting controls provision is not limited to just accounting and financial reporting. So the first matter is the charter communication settlement, which came out in November, where the commission alleged an internal accounting controls violation in connection with a stock buyback and imposed a $25 million penalty. This is the second time the commission has brought an accounting controls action in the context of a stock buyback program. Many of you might remember the Endeavor case from 2020 generated a lot of buzz when it first came out. The facts of Charter are a little bit different than Endeavor. And in Charter, the issue was the company's compliance with a Rule 10b5-1 plan. As you know, Rule 10b5-1 plans are just sort of a defense to improper trading allegations, sort of a safe harbor. In this case, the SEC's allegation was that although the company tried to comply with a 10b5-1 plan and with the rule, they did not, in fact, comply with it. And because it did not comply with the rule, in the SEC's view, management engaged in an internal accounting controls violation. What's interesting about the order, if you read it, is that the order actually describes some of the controls that the company actually had in place around stock buyback. So, for instance, one of the controls the company had was that stock buybacks should be accurately recorded in the accounts and ledgers. That sounds like a reasonable accounting control to have around a stock buyback, but that wasn't enough for the SEC, and so very clear here that the SEC is sort of continuing the trend of what started in Endeavor, where they're looking at the accounting controls provision to go beyond simply accounting and financial reporting. The second example, I think, sort of takes that to the next level, and that is the SolarWinds case. I'm sure all of you know about SolarWinds, cybersecurity litigation, companies alleging the company made false and misleading statements about cyber hygiene and its cybersecurity controls. But there is a very interesting internal accounting control theory buried in SolarWinds' case. It hasn't received a lot of attention. The SEC actually filed an amended complaint in February, which they sort of expanded on their theory of accounting controls. And the SEC's theory essentially is that the cybersecurity controls the company had were in fact accounting controls. And when the company had deficient cybersecurity controls, they also had deficient accounting controls. Sort of a couple of logical steps in there, but I think at the core of the SEC's theory is that cybersecurity controls are designed to protect a company's computer code, their software, their technology assets, and when there's a hack, when there's a cyber breach, and those corporate assets are not protected, that's an accounting controls violation. This issue is being litigated right now. The U.S. Chamber of Commerce actually filed an amicus brief arguing against the SEC's interpretation of the accounting controls provision. Oral argument was held just a few weeks ago, so we might actually get a decision, in addition to the disclosure issues, on the accounting controls provision as well. I think the takeaway for me here is it's hard to see a limiting principle to the SEC's current theory, right? So if any internal control to the extent it sort of impacts a company's assets or the management's ability to properly comply with the law, which is a charter, then sort of every internal control could also then be an internal accounting control. And that's what gives the SEC a lot of scope to go and investigate the inner workings of a company. To paraphrase Matt Levine, who says that sort of everything is securities fraud, it's sort of like looking like now, every internal control, every violation is an internal accounting control violation as well.
I think sorry, go ahead, please.
Okay, I just wanted to point out that this is coming straight from the statute, so it's 13B. 2B of the Securities Exchange Act. It's been in place for a long time, and there's 3 subsections of that statute. One talks about the most commonly known internal accounting controls, GAAP. The second part, though, is reasonable assurance. You have to have internal controls to provide reasonable assurance. You're only engaging in transactions authorized by management. Or the last section is reasonable assurance for that the access to the company's assets is only permitted in accordance with management's authorization. So even though these are new cases, it's written right there into the law. So
I think we'll see. I mean, there was a lot of discussion at the motion to dismiss hearing. I think the judge was scrutinizing because it is it's in the law, but it is a novel set of facts, a novel application. I think you have a point in terms of, what is the limiting principle? The other thing I would add is the penalties are being ratcheted up, not just the SEC bringing standalone internal accounting controls cases, but also now those cases, whereas previously they might have been like $5 to $8 million, now they're like $12 to $15 million, which is where I think most of us in the room would say, well, that would be where a negligence-based fraud or a scienter-based fraud might be. So that is also just a new trend that I'm seeing in terms of that space.
Yep, I think this is just the beginning. So Fuad, perks. I think the question here is, what is the SEC's obsession with plain? Please explain.
So this is actually an area where there's been, I'd say, a remarkable degree of consistency and predictability in the SEC's approach to perks enforcement, unlike some of the other areas we've been talking about today. Charges have been relatively consistent. The penalties have been relatively modest, low single-digit millions. And companies are being rewarded, have been rewarded when they come forward and sort of acknowledge they made a mistake. The SEC has been sort of recognizing that. So most recent case you've already heard about today is the Stanley Black & Decker case, came out last summer, involved airplanes. Failure to disclose $1.3 million in perks provided to executives. No penalty because of the cooperation remediation. We've already talked about that. If you look at the order against the company, it's actually very thin on what the alleged error was that the company made. There's a companion order to that case where the SEC charged an executive. And if you look at that order, you actually get a sense of what the failure was, which is the executive's failure to properly respond and answer a D&O questionnaire. And you see that a lot in these cases, right, where an executive doesn't properly fill out a questionnaire and the information doesn't get to the people responsible for making disclosures. And that's sort of typical among these cases. The one point I'd make about Stanley Black & Decker, it's great that the commission was sort of acknowledging and rewarding this company for coming forward and admitting that there was a mistake and the company got a zero penalty resolution. That same week that Stanley Black & Decker came out, there was another resolution that the SEC entered into. It also had self-reporting. It also had cooperation. It also had remediation. So it sort of checked all the boxes that Stanley Black & Decker had checked, but the SEC did impose a penalty on that company. Now, it wasn't a perks case, but it was an accounting misconduct case. And I think perhaps it was a missed opportunity for the commission to sort of explain, here are 2 cases, both of them involve self-reporting, cooperation, and remediation. Only one got the benefit of a no penalty resolution, the other did not. So we're sort of a bit of a muddled message and not really clear why that other company did not get the benefit of a zero penalty resolution.
So we didn't hit Panawatt, but we did get to cooperation credit. And so I just want to thank our panelists. It's a very, very fun talk.